Hello. In this video, we'll be discussing zero coupon bonds. What are bonds? Bonds are a way for a corporation to raise funds without having to go to a bank to borrow money. Instead, they go out to the open market and they can sell their own bonds issued by their own company in increments of either $1,000 or $5,000. So the investor, anyone can buy a bond, including you, as an individual. You give the corporation money, and then in turn, they will give you money plus interest sometime in the future and in increments. So when we talk about bonds, usually there's a stated amount, which is the face value, and also called principal par value, face amount, or maturity value. Plus, there's some sort of stated interest where there's interest payments made by the issuing company to the bondholder. However, there are these special bonds called zero coupon bonds, and zero coupon bonds pay no interest. The stated interest on it is actually 0%. And so they sell these bonds at a deep discount. It's when company needs money urgently, and then they will pay out sometime in the future the full face value of that bond. Now, the company that issues the bond still can deduct for tax purposes, the annual interest expense, because the difference between the cash value that they receive versus the face value of the bond is considered all to be interest expense in that situation, even though there's no actual cash interest payment made. The investors, the bondholders, receive no cash interest, but they do need to report the interest revenue. Just like the bond issuer reports interest expense, the investor will have to report interest revenue. So who would do that? What kind of company would actually purchase a zero coupon bond when they have to recognize interest revenue without actually getting cash for the interest? It would be only usually a tax deferred or a corporation that has a tax exempt status that don't have to pay tax on their revenue. Let's look at an example. So Coca-Cola Enterprises, which had a stated interest rate of 0%, issued some zero coupon bonds. Coke received $247 million in exchange for issuing a zero coupon 25-year bond with a face value of $1.900 million. Prepare the amortization table for the first 3 years using the effective interest method. Before we can prepare that, we have to calculate what is the effective interest percentage or the market rate. And the way we do this is we know that we need to find out the present value factor in order to find out what the interest rate is. So we know the present value of $1 equals the face value times the factor from the present value of $1 factoring amortization factoring table. So we are told the present value is 247 million. The face value is 1900, and the factor is unknown. Let's solve for x. So if I divide by both sides by 1900, I get x equals 0.13. So the factor that I'm looking for is 0.13. I know that my number of periods is 25 because we're told that right up here. That's a 25-year bond. The interest is, we don't know. We have to go to the present value of $1 table, look for a factor of 0.13 when the number of periods is n equals 25. So here is a present value for single cash flow, which is the same as present value of a table. I'm looking for under n equals 25, my number of periods. So in this very last row, I'm looking for 0.13. There is no 0.13, but 0.13, I don't know why this thing keeps popping up. So 0.13 falls right between these two numbers, between the 0.1460 and the 0.1160 when n equals 25. And if I scroll up right here, that's between the 8 and 9%. The n equals 8.5%. That's just mathematically what it ends up being. So the I we figured out is 8.5%. So now we can prepare our amortization table using the effective interest method. So the effective interest method, if you don't know how to calculate it, please look at a previous video. But we take our outstanding balance or the carrying value of our payable, which is going to be 247 million. That's the starting value. And what you do is you take your stated interest rate times the face value, but our stated interest rate is 0. So there are no cash payments. But then you take your carrying value of 247 multiplied by your effective interest rate, which is 8.5%, and that equals 21. And so when you have a discount, you're going to keep adding this discount reduction onto your outstanding balance. So at the end of year one, which is 1995 in this situation, our outstanding balance is $268 million. So then you carry it forward to 1996, and you're going to take your 268, your outstanding balance, the ending outstanding balance from the prior year, multiply by 8.5% equals 23. So now the discount reduction is 23, and now that gets added into the outstanding balance. So as the discount reduction is increasing, if you will, right, then the outstanding balance also increases, and that happens when you have a discount. Same thing the following year in 1997, our cash interest payment is 0. You take your ending outstanding balance from the prior year times 8.5% is 25, and then you add the 25 to your outstanding balance and becomes 316. So on and so forth. You keep doing that, and 2020 is the last year, and you've added now again your when I say add, you're crediting your discount on bonds payable to get to 1653, and your outstanding balance will end up being $1,900. I didn't do this earlier, but I realize now that I should have. But when you first in the initial journal entry to record this transaction would have been that Coca-Cola got cash for $247 million, right? They have a bonds payable for $1,900 million, and then they had a debit called discount on bonds payable for $1,653 million. And that discount, right, is a contra liability, and it's a debit balance. We start with 1653, and that was, let's just call it 1/1/1995. And for each year that this discount gets amortized, it would have been a credit, right? So that's why it's called discount reduction, because we're reducing the 1653 balance. So we're going to credit 21, and then the following year is a credit of, I think it was 23. And so eventually when you get to 25 years, the discount is going to be 0. But that's why it's called discount reduction. You're reducing this debit balance every year.